Welcome to Bloomberg ETF IQ. I'm Sonali Basak, in for Katie Greifeld today.
And I'm Matt Miller on a day when we have, not surprisingly, a lot of M&A action because it's Monday.
Yeah,
right?
absolutely.
But,
means things are stabilizing.
Also a lot of bankruptcies over the weekend.
You can have both, apparently.
That took me by surprise. All right, let's get into the biggest stories now in the more than $9 trillion global ETF industry. And it is growing, but by how much? Maybe $30 trillion in the next decade. That's according to a prediction from Brown Brothers Harriman. We'll dig into their latest survey.
And the ETF we have all heard about in 2023 is KRE. That is the Regional Banking ETF. We are going to take a special look inside that fund.
And we're going to discuss the pushback against ESG ETFs as MSCI conducts a sweeping overhaul of how it applies its ratings to those funds. And we'll talk about the political backlash growing in the sector as well.
And the performance as well. But Matt, as always, before we get there, Eric Balchunas from Bloomberg Intelligence is here, and he is looking at the flows.
Thank you, Sonali and Matt. Look, the flows have a bit of good news. We've got two equity ETFs at the top, U.S. equity ETFs. Why am I looking for this, right? U.S. equity ETFs, this is fascinating. This year, they've only taken in $10 billion all told. The last 2 years, they've taken in $2 trillion, right? So this is a really interesting thing where investors are not buying into the equity market. We call it the FOMO drought. Instead, they're buying fixed income and other things and money market mutual funds. Let's look at the outflows here. And you can see, even though there was some inflows into the equity ETFs, look at the outflows from the Qs, right? Negative $2.5 billion. 1 month outflows, year-to-date outflows. Now, the Qs is up 22% this year. That's weird. Normally, 22% is going to get you some buyers, but not this year. And this FOMO drought continues to go on likely until, as long as interest rates remain high and those yields remain high, it will probably keep sucking money out of equities. Now, speaking of things sucking money out of equities, there's also gold. Gold has taken in 13% of the flows in May. Why? This is a hedge on the debt ceiling, a potential default in the U.S. Now, it's the unlikely scenario. We had Bill Gross on last week. He thinks it's going to get resolved like every other time, and you should buy short-term treasuries, which many people are. But certainly, gold is one way to hedge this, and people are doing that. So people are buying the resolution and the hedge at the same time until we get a situation resolved here on this.
All right, or not, right?
Or not.
Because it seems like
it's been like 70 times they resolved it, but maybe 71 is.
It seems a little bit more likely that they don't this time. I don't know if I'm just looking at this pessimistically. Eric, thank you very much. Joining our conversation is Shawn McNinch, Global Head of ETF Services at Brown Brothers Harriman. Shawn, before we get into your survey, which is fascinating, so I do want to explore it in depth. What's your take on the debt ceiling situation? Doesn't seem like the ball's been moved very much, but it's a little bit scarier this time than it has been any time in my memory, really, since 2011.
Yeah, I mean, we're seeing a lot of increase in fixed income ETFs, right? So about 2/3 of the net flows into the fixed income products with that, so I think there's definitely a different shift in asset classes that investors are really demanding more and more fixed income space.
Fixed income, but what kind of fixed income, Shawn? Something I'm really curious about is this move into LQD and HYG at the end of the last year. They haven't done a whole lot of movement here. They haven't had a whole lot of movement in terms of very positive returns. When does that start to pay off? And do you think that more investors are more interested in other forms of corporate debt when you look at the ETF world?
Well, I think short duration is definitely an area of growth for the ETF market, as well as there's been more of a shift from more corporates into more treasury-backed type products where they're moving to more safety. I think as interest rates continue to rise, investors are really looking at the fixed income space to gather some yield.
So, Shawn, let's shift to your survey. The big number that stood out, you guys are predicting $30 trillion in ETF assets globally in the next 10 years. That's a lot considering they have 9 today. I looked at this. I wrote a note saying you'll eventually be correct. I'm directionally with you. I'm spiritually with you. I think you need the market to help you out, though. And that the question is, we've had a huge run the past 15 years. Is there enough gas in the tank for stocks and bonds to go up enough to help that? Because I'm not sure flows alone gets you to 30 trillion. What's your take?
Yeah, Eric, I completely agree. I think you're going to need to get market appreciation into the ETF space. I think if you look at the last 10 years, it's been about 20%, bull market. So we're going to need to get, continue to have some bull markets over the next 10 years in order to get to that $30 trillion mark. However, I do think regardless of the market appreciation, there's really significant tailwinds behind the growth of the ETF. ETF toolbox continues to expand with new asset classes, new structures. There's a lot of investor demand. Over 60% of investors plan to increase their usage of ETFs. There's new distribution channels coming into the market as well that are really adopting ETFs as a core underlying asset class. More fund managers buying ETFs as part of their overall portfolio. So I do think there's significant tailwinds, especially as you're looking at this mutual fund ETF conversion in the marketplace, where we saw net flows into ETFs last year about $850 billion, while we saw an outflow of about $800 billion into mutual funds.
Yeah, no, certainly. Plus, Vanguard's patent is expiring that allows ETF share classes of mutual funds tomorrow, actually. That could help. I want to talk about one of the other survey questions in here. What's the most important factor when selecting an ETF? Number one, expense ratio. Number two, ETF issuer. Those two were reversed last year. So brand and fees matter. To me, this is very good and explains a lot about the big two, Vanguard and BlackRock. They take in 2/3 of the money every year. It's astonishing. And I think this explains that. How do you see the rest of the industry kind of eating into their market share if this remains to be the most important factors?
I really think it's about the type of products, right? So if you think about your passive equity ETF, expense ratios are in the single digits to, on average, maybe about 15 basis points. Fixed income ETFs even lower. But I think the next evolution of growth is really more in the active ETF space. And I think there where expense ratios may not be as large a factor versus the passive market. So I think that's where you look at the next 10 years, more complicated strategies that will have more higher expense ratios that will definitely see that. And it'll come down to more about what's the potential return on your investment versus just getting, cheap beta exposure. And so I think those traditional screening where they're looking at performance and total cost of ownership will be a major factor into the next evolution of growth in the ETF space.
Shawn, we're going to talk to Shaheen Contractor from BI about ESG, and it's gotten, it's had horrible backlash this year. But your survey is very bullish ESG. Is that because you see a recovery and sort of the political acceptance?
Yeah, I think this was probably a surprise to me, just especially on the U.S. results. I think this is really about three different geographies. You have the U.S., Europe, and then Asia. Obviously, Europe market is definitely more evolved, and they're embracing ESG ETFs in that marketplace, where they have about 65% of all flows last year were in ESG. And that represents about 20% of the market. In the U.S., there's been a big pullback in the first half of the year. A lot of media attention around greenwashing, index providers reclassifying some of their indexes that were ESG and taking that classification off. A big pullback on the institutional investors as well. So I think it's definitely what I would say is it's different across geographies. Right. And I think time will tell if investors will put their money where their mouth is in the U.S.
Well, and if it's hated right now, what a time to buy. Shawn, thanks so much for joining us. Shawn McNinch there of Brown Brothers Harriman coming on to talk to us about their 10th annual survey, ETF survey. Coming up, that backlash against ESG is having a major effect on ETFs this year as the liquidations pile up. We'll talk about with Shaheen next. This is ETF IQ on Bloomberg.
Welcome back to ETF IQ. I'm Sonali Basak, and it's time now for the ETF Brief, where we're going to highlight stories and trends that caught my eye. I want to start with corporate bonds because LQD and HYG, these are two tickers here that drew a lot of interest last season for the big hedge funds and family office managers. We are waiting on a 13F deadline again today as well. These two tickers, they haven't done all that great. You have about a 1% and a 2% rise when you look overall. So the big question is, have they still still attracted more interest. We're also going to turn over to emerging markets, because when we take a look at emerging markets, we are looking at a big retreat. We are looking at 2 weeks really worth of outflows here as investors have retreated. Now we're looking at a presidential election cycle here over in Turkey, and that has meant there have been some jitters over the EM world after large inflows earlier this year. We're also going to talk about ESG outflows, because liquidations of ESG ETFs could continue to increase on slowing flows and volatile markets, especially in the United States. Average flows in the year prior to liquidation have been largely negative and small in assets, and that suggests that struggles have been collecting among these investments, Matt. And we're going to talk more about this issue, I know, with our next guest.
Yeah, absolutely. I mean, I've been talking about this for months with our next guest. She's a big favorite of mine and Paul Sweeney's on Bloomberg Radio. Let's welcome her to television. Shaheen Contractor, ESG analyst from Bloomberg Intelligence. So, Shaheen, this is something that, you've been studying in depth for quite a long time for us here at Bloomberg. Why do we see this incredible backlash against ESG? And more importantly, what kind of effect is it actually having in terms of the numbers?
So, Matt, when it comes to the backlash, I think the whole complex is that ESG has become a political thing when it really shouldn't. I think if you think about the impacts, I really think that's going to exasperate liquidations. Now, we've spoken about this. I don't think the asset declines are due to the backlash. That being said, what we really need is a wider investor base, right? To move beyond just institutional investors to more retail audiences and things like that. What this backlash could do is it could stop that widening of the investor base and prolong the slowdown. So I think now we're starting to see sort of real tangible impacts and potential liquidations.
So on top of the political backlash, you had mentioned that this is not necessarily why you think outflows have materialized. So what are the key reasons they have?
So there are two reasons. The first and the main one is concentration risk. So in other words, ESG has grown due to these handful of very large allocations from a few investors. So when that comes out, due to reasons either be ESG or other than ESG, it's very noticeable. The second is clean energy. So clean energy sort of peaked in 2020, and then it sort of came down off its highs. So that tapering off in flows was again very noticeable.
So we have seen some changes in, for example, the energy sector, right?
Yeah.
The invasion of Ukraine in that time, as well as more and more products coming out. We just heard a very bullish forecast from Brown Brothers Harriman, for example. Of course, that goes 10 years out. Is there a possibility that this turns around and starts to grow again?
In the long term, hopefully, would keep my sanity. I guess over the short term, I really do see this political backlash having implications. That being said, Europe is, it's almost its own sort of ESG driver.
There are big regional differences.
There are huge regional differences. Europe sees much more favorable policy. Its asset owners have sort of shoved ESG down the throats of everybody for a very long time now. So it's much more accepted. It's much more sort of understood. And I see growth actually to be very driven by Europe, at least over the near term.
You had mentioned clean energy. How much of the clean energy story is part of the overall ESG story when you're thinking about the ETF universe? ESG is such a broad category, and are there certain areas that perhaps drive more interest than others?
So clean energy tends to be very volatile, right? So what happened was when Biden came in, everybody anticipated favorable clean energy policy. So flows went 10x, and I'm not kidding, it went from 10 million to billions. And that being very policy driven sort of comes down off highs. So ESG as a whole tends to be more sort of benchmark hugging. Clean energy will be cyclical up and down.
Shaheen, thank you so much for your time. That is Shaheen Contractor of Bloomberg Intelligence. And still ahead, we're going to drill down into Treasury ETFs with Joanna Gallegos, co-founder of BondBloxx. That is next on ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Sonali Basak.
And we also have Eric Balchunas from Bloomberg Intelligence back with us with today's drill down, on where we focus on just one ETF. Eric.
Thank you, Sonali. Today we're going to look at XONE. It's the BondBloxx Bloomberg 1-year target duration U.S. Treasury ETF. And I got to say, this name does a good job describing the ETF. Not all of them do. It's 1-year target duration for U.S. Treasuries, right? So it's very plain vanilla. But this year, short-term plain vanilla Treasuries are a big deal. This thing yields 4.8%. That is up from a year ago, and so you have a lot of money pouring into this thing. It's already $668 million, and it only launched about a year ago, and its expense ratio is 3 basis points. So that's cheaper or as cheap as Vanguard, BlackRock, and Schwab. So it's right there in that sort of dirt cheap realm. This is likely to get hits with that. Let's look at the holdings, and you can see it's very vanilla here, right? 2024 yielding Treasuries. We now have this on the DS screen, the duration. You can see it's just about 1 year, and that's the goal here. That's what makes this thing a little different. Other Treasury ETFs are 1 to 3 years, or they're targeting a specific year out in time. This is just trying to nail 1 year duration as we roll along. And this is sort of the angle this ETF takes. You look at the performance versus some of those that I just mentioned. This is the 1 to 3, and this is the 2024. I mean, they're all kind of similar. You can see this one actually just, did better during that downturn, but all in all, it's going to depend on what matters to you. And if precision matters to you, Sonali, Matt, this will appeal to you. And we saw a big investor get into this, and I think it's probably going to appeal to institutions.
Absolutely, Eric. We're going to talk more about this ETF with Joanna Gallegos. She's the co-founder of BondBloxx. Joanna, thank you for joining us here. We're talking about all of this in the vein of not only a regional banking crisis, but a lot of concerns about the debt ceiling. When you're looking at the way that investors are thinking about how to invest in fixed income, what is their number one concern?
Yeah, I think precision. Eric hit it right on the head. We built BondBloxx to give fixed income investors more precision in markets exactly like this. There's a lot of differentiation in fixed income right now, and we didn't launch 1 Treasury fund, we launched 8. So as you go along in this market, you look at the second half of this year, you can move or add duration to your portfolio very specifically with our product line. We wanted to make sure that investors had enough tools to do that, both in duration and in credit.
You know, we just saw a headline come across the terminal that President Biden is going to meet with congressional leaders on Tuesday. We already knew that, but it bears repeating because investors are so focused on this debt ceiling issue, right? Are you seeing that in the uptake in your products?
Yeah, I think what we're seeing is clients are expressing their views across duration and across credit. Like, there has been some movement into intermediate duration in our products, and I think that trade that you mentioned last week into 1. Our most popular trade, last month and the last 6 months was half, which is a 6-month product. So I think that, again, these tools allow you to respond to these markets as they develop, and we sort of need to think about how we're going to ride through not only those concerns, but concerns about recession or sticky inflation. I think that's what investors are looking for, is to break up the exposures in fixed income right now and build them differently.
So it's interesting to me. You guys have these plain vanilla Treasury ETFs. That's where most of the flows are going in your family. But then you've got some more exotic stuff. One of them is XCCC. This is the most junk bond ETF on the market by far. Only has CCC junk bonds, and it yields 14%. But people are not biting on it. It's interesting. That is a wide spread. You'd think that'd be enough to get bites. What's the deal?
You would think so. I think what we're seeing is obviously the income is back in fixed income again, and it provides a lot of cushion for you to ride out any potential spread widening this year. It also gives you a head start on equity returns this year. And the thing that I think we want people to take away about credit, and specifically about high yield, is it's a much higher quality high yield than it was in past downturns. And so you're not seeing a lot of the distress you would normally see. There's a product, if you want to kind of have it both ways, there's XBB, which is just your first entry into high yield. It's surprising to people. I mentioned this on the radio about a week ago. It only has a historical default rate of 1%. And there's a lot of falling, angels in those spaces. So you kind of get a lot by looking at high yield differently and cutting up the exposures to really understand them better. It's just not the same cycle.
But what do you tell investors who still think that the worst is yet to come? I mean, we saw 7 bankruptcy filings in 48 hours. And so I think that there's this big concern that the pace you're seeing is still the worst you've seen since 2009. And these companies are very highly levered, right? So how do you make sure that there's some protection there?
I think the important thing is you can look at our product set and you can see all the things that are going on, whether it's by credit rating or by sector, and you can evaluate exactly the fundamentals that you expect to see downgrade or turn to the worst. Versus before, if you look at the category as a whole, it's hard to pick that out. One thing is that there hasn't been a way for you to buy CCC in a diversified way. This is a diversified portfolio with hundreds of securities in it, and it's not the same thing as buying a few of those names and having to pick and choose what kind of idiosyncratic risk you're putting in your portfolio. There is a diversification approach here that's different, and now that it's available, I think it's worth looking at.
I mean, I think your product offering is so cool because it's a set of tools, right? But they're a better made set of tools than you can get anywhere else. So it's like a snap-on set of a diversified bond tools, because otherwise you'd have to put them together yourself or find other issuers.
Yeah, last week it just stuck with me. You said, you know, clients need your products right now, and we couldn't be more passionate about showing people all the differentiation that's going on in fixed income and having people be able to play it the way that they're viewing it. And I think recession fears and their expectations for this year are really important to express. So all the way from a treasuries onto CCC and a lot in between, it allows people a lot of choice right now. Joanna,
thanks so much for coming in. Joanna Gallegos there from BondBloxx. Before we go, here's a special look at another ETF. This one has become a superstar amid the recent banking turmoil. Probably the most talked about ETF of 2023 is the Spider S&P Regional Banking ETF, the ticker KRE. The regional bank turmoil of failed banks and fleeing deposits has caused trading volumes to hit records. Woes engulfed the sector since early March amid concerns that big unrealized losses on bond investments might push some banks to the brink, and 4 did in fact collapse. Worries remain, especially the group's high exposure to real estate lending. Throughout this stress, KRE has reflected the volatility in regional bank stocks, with returns tumbling. The ETF comes with an expense ratio of 35 basis points and holds around $3 billion in assets, with about 140 holdings tracking the S&P Regional Bank Index. Notable names include New York Community Bank, PacWest, Regions Financial, and First Horizon. It is a green light in the Bloomberg Intelligence traffic light system, with one warning for its alternative weighting. Honestly, has to be the most talked about, the most well-known ETF at this point. In fact, I think a lot of people just think this is the index.
Yeah, well, I mean, as an analyst, this thing was just another ETF for 10 years. I'm telling you, every now and then the soccer ball gets kicked to a weird part of the field, and there's an ETF ready and waiting, and KRE is that ETF this year.
I do like to look at MRR Go. That was those member-ranked returns.
Yes.
Almost everything in the red, barring 5 stocks.
Yep, and you can run a move function on it. It does work like an index on the Bloomberg terminal, which is great for us. That does it for Bloomberg ETF IQ. I'm Matt Miller, along with Eric Balchunas and Sonali Basak, in for Katie Greifeld, who is out because she's celebrating her pre-birthday. The actual day is on the 18th. This is Bloomberg.